Sasol says it's making good progress and so expects to meet most of its financial guidance for the 2025 financial year. That's as the global chemicals and energy company achieved volume guidance across most of its business segments. The firm has forecast that its annual earnings per share will be at least 20% higher. This will be an improvement on the loss per share of close to 70 Rand it reported a year ago. But Sasol has cautioned that earnings and headline earnings per share could still be impacted further by adjustments resulting from the 2025 financial year closure process, and so can't be estimated reliably at this point. The group will release its full year results on August the 25th. Reinet has posted a 4.6% decline in net asset value for the quarter ended June. This reflects decreases in the estimated fair value of some of its investments. The Johan Rupert-chaired investment vehicle says geopolitical tension and economic risks remain heightened, and market uncertainty continues to be affected by the Ukraine crisis, turmoil in the Middle East, and ongoing global trade tariff negotiations. And while inflation and interest rates are slowly trending downwards, there remains a risk that they may increase again. The SA National Roads Agency has concluded a loan agreement to the value of 7 billion Rand with the New Development Bank. The funds will support various projects in the toll portfolio, in particular the key economic corridors along the N2, N3 in KwaZulu-Natal and the N1. It will become effective as soon as the standard conditions precedent have been met. SANRAL says it's looking forward to the positive impact that will emanate from the long overdue funding that will greatly assist the entity in carrying out its mandate. FlySafair will resume wage talks this week. That's after a pilot strike disrupted dozens of flights, threatening operational continuity at the country's largest low-cost carrier. Trade union Solidarity is demanding a 3-year deal with front-loaded salary adjustments, 10.5% in the first year and CPI plus 4% annually thereafter. The airline has tabled a counter-offer of a 5.7% increase in the first year, followed by CPI plus 1.5% in the second and third years. Commenting on the industrial action, aviation expert Guy Leach noted that the strike was not very big, but he added that a lot worse could still happen if the situation drags on. And on the data front, the composite leading business cycle indicator decreased 1.3% month-on-month in May. This follows an upwardly revised 0.6% fall in the previous month. The latest reading marks the second consecutive monthly decline. This reflects downwards in 9 of the 10 available component time series. The largest negative contributors were decreases in the number of residential building plans approved and the volume of domestic orders received in the manufacturing sector. The only positive contribution came from an increase in South Africa's US dollar-denominated export commodity price index. Further afield, Swiss chocolate maker Lindt and Sprengly raised its organic sales growth forecast for 2025, citing consumer loyalty and a trend towards more premium products. Here's more detail in this package report.
Rising costs aren't stopping Swiss chocolate maker Lindt and Sprengly raking in sales. The firm said that revenue hit close to $3 billion for the January to June period, beating forecasts. That prompted it to raise its growth outlook for the year to up to 11%. Shoppers apparently weren't put off by hefty price increases for its products. They went up close to 16% over the period. Much of that was driven by high prices for essential ingredient cocoa. It's been trading at elevated levels following poor harvests in key producer nations. The maker of Lindor chocolate balls said it had benefited from strong customer loyalty and a trend towards more premium products. Sales in Europe led gains, with growth of close to 18%. But North America looked a lot weaker, with a rise of just 3.6% amid weak consumer sentiment. Lindt also faced foreign exchange headwinds, with the Swiss franc soaring during a period of global economic turmoil. That cuts the value of its overseas earnings when changed into its home currency.
And China's BYD is delaying mass production at its new $4.64 billion electric vehicle factory in Hungary until 2026. The plant will operate below capacity for at least the first 2 years, producing only a few tens of thousands of vehicles in 2026. Here's more detail.
China's BYD will delay mass production at its new electric vehicle factory in Hungary until 2026, according to sources, and will reportedly run the plant to below capacity for at least the first 2 years. One source added that at the same time, China's #1 automaker will start making cars earlier than expected at a new plant in Turkey, where labour costs are lower. Shifting production away from Hungary in favour of Turkey would be a setback for the European Union. It's been hoping that its tariffs on EVs made in China would bring in Chinese investments and well-paid manufacturing jobs. BYD's $4.64 billion plant in southern Hungary will reportedly start mass production in 2026, but only make a few tens of thousands of vehicles over the whole year. That would be a fraction of the plant's initial production capacity. Meanwhile, one source added that BYD's $1 billion plant in western Turkey will far exceed 150,000 cars in 2027. BYD did not respond to requests for comment. The automaker is building the plant in Hungary to sell cars in Europe tariff-free. All the cars it currently sells in Europe are made in China and subject to EU anti-subsidy tariffs on Chinese-made EV imports. Its total tariff is 27%.